The big thing is really, like, as you said, you have higher oil prices, you're starting to see wage gains, corporate earnings have been very good. Inflation gauge, you have inflation measures or inflation expectations now sort of firmly above the Fed's 2% target. So in our view, we've been looking at a range for the 10-year Treasury of around 3.25 to 3.5%. We think at that point you're getting more broadly imbalanced with the positive economy that's still working through a lot of structural issues. We do have to point out that we are a largely consumer-driven economy, and while wage gains have been strong, they haven't been so strong as to say that we're really going to raise our target on the 10-year much above the 3.5%. But we do acknowledge, though, sort of tuning down some of the trade rhetoric abroad, some of the geopolitical concerns seem to be abating, and rates are really refocused on the U.S. economy, which is why we agree with what both of you had said at the start of the broadcast, which is the positive data and the positive momentum is outweighing a lot of the negative headwinds.
I mean, I can't imagine that when the Fed is meeting now, given what Powell said, they're not all on the same page, because I didn't hear this from a lot of the other guys that we talked to. I heard we're almost at neutral already, we're ready to stop, this, that. I don't know whether the data changed, but this is that was kind of a shocker to hear that, wasn't it? We're nowhere near neutral.
We think that we're really in the midst of one of the most elongated tightening cycles. So the Fed, like any other governing body or group of people in a large meeting, the transition of the rhetoric and transition of the policy's core beliefs is also going to take some time to sort out. But the way we've been viewing it, really, if you look at the positioning of both our corporate income and our Core Plus bond fund, has been you can't fear the Fed at the same time you don't want to fight the Fed. So our perspective has been to keep Treasury duration or that sensitivity to rates a bit lower and to sort of ride the wave of the U.S. economy and be more constructive and capitalize on the corporate bond market by investing heavily in corporates. We think that's most in tune with this transition at the Fed, where the policy of the committee is coming around to embrace an economy that is finally getting in line with the fabled dot plots that have shown the Fed's estimates have been quite a bit ahead of what the market was pricing. And as those two reconcile, I think you'll see more of a convergence of the core belief of the Fed.
Although Powell said yesterday, look, we could raise faster or we could raise slower. I think he's trying to get you away from even looking at those dots and trying to take anything away from it. That sounds to me like more volatility.
The truth is volatility has been extremely low. And, Becky, you point that out, and it's 100% correct. If there's one thing the Fed also values, like any group of investors, effectively, is optionality. And if the Fed can sort of widen the expectations around their core dot plot or the expectations around the core pieces of economic data that we're all looking at, that gives them optionality to either announce neutral at a certain point when we arrive there, or if they arrive at the point that they thought might have previously been neutral and realize they still have to go an inch or two further, they've saved some dry powder. Because the reality is this economy is now starting to show signs of life that many of us had written off over the past 5 years.
All right, thank you. Let's get to Jeff. A lot of Midwest common sense I see here. You live in Chicago, though, don't you?
I live in Chicago.
You had all the opportunity to live in Cincinnati working for Fifth Third, but...
They moved me to Chicago.
But you've been to Paris. Why would you go back to the fall? Yeah, you've been to Nirvana. So you're not a big believer in seasonal trends. However, it's the opposite for the midterms this time. Usually stocks don't do well prior to midterms and they go up after it. And instead, we've had a very strong move before the midterms. Yeah. So we may have the opposite after?
Yeah, I think, there's a possibility. The markets have not really digested very much of rising interest rates. They've been able to shrug them off, and I think they're starting to take a little bit of a bite. That being said, we're staying with our overweight to equities. The U.S. economy is still certainly in fairly good growth mode. We're above trend growth. We think we can keep that up for some time.